Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for joining us. The Fed is on a path to continue its tightening cycle, but the question is that a risk to overall economic growth and general health of the economy? We're going to talk about that right now with Eddie Gabor, co-founder of Key Advisors Group and a frequent guest here on UBS Trending. Eddie, always a pleasure to have you join us. Thanks for being here. Got a lot of questions for you today.
All right. Thank you for having me.
Of course. So the first thing is, of course, we're all looking at what's going on with the comments from the Fed. We know that the recent minutes from the Fed's two-day meeting back in June, in there we saw that the FOMC is committed to raising rates as high as necessary, they said, to tame inflation. But then over the last weekend in Jackson Hole at the symposium there, Jay Powell confirmed that there would be no, what he called a Fed pivot, where they would start cutting rates anytime soon. So the question is, when is too much tightening a risk to economic growth? Because the markets, clearly, the equity markets did not like his comment about the no Fed pivot. So clearly there's some consternation there.
Without question. And look, personally, I think they've already done too much. We have never seen tightening happen this fast in this short a period of time. And the problem is we run the risk of over tightening. And that's what essentially, in our opinion, is going to happen, because it takes months for these rate hikes to actually materialize into the data. So, we're not even going to know to the beginning part of next year what the rate hikes happened this year so far has had the impact. So we believe now we have gotten confirmation, what we have been telling investors and our clients all year, that the probability of a soft landing based on what they're going to do is very low. So we now continue to think that we're going to have a recession next year. We think it's going to be worse than what the market is currently priced in. And this is why, if we had to make a bet, we think we're going to see lower lows before we get a new high in the market sometime within the next 6 months. So we are in uncharted territory right now. We have never had an economy slowing this fast while a Fed is tightening this fast. And I just don't see any high probability of them being able to navigate a soft landing, unfortunately.
Yeah, and it's the soft landing that it seems like economists and marketicians and investors alike are all looking for. Clearly, the inflation word is thrown around quite a bit, and that's where this is all stemming from. And you got to look at what's going on with the 10-year yield specifically, that benchmark 10-year. Right now, it's about a 3.12 as you and I are talking here, versus it was a 2.60% just at the beginning of August, so less than about a month ago. Does that bump indicate to you that inflation has not reached a peak and it's still a concern? Because when it went down to 260, everybody thought, okay, maybe the worst is over, but now we're spiking again. Or is that basically coming from what Powell is saying?
It's a combination of two things. Number one, coming into Jackson Hole, the market was pricing in this pivot that, again, I don't know why people were pricing that in, because the Fed has been very clear that they're trying to get inflation down to 2%. So it was an overshoot based on what happened in Jackson Hole. But I think the other signal that it's telling us is inflation, whether it's peaked or not, can be debated. But I think one thing that can't be debated, in our opinion, is it's going to be sticky for a while. I think it's unrealistic to expect an inflationary rate of 2% anytime soon, because food costs aren't going to come down dramatically. Rents aren't going to come down dramatically. And just rents alone are enough to keep inflation higher than where the Fed wants to be. So this is why this narrative that they're going to continue to tighten until we get down to 2%. I think ultimately the economy and the market will call their bluff sometime next year, because inflation is just going to be very sticky no matter what they do.
Yeah, you could see it even, New York is a bit of an outlier a lot of times when it comes to apartments. Everything here is a lot more expensive than in a lot of parts of the country. But we have seen rents just skyrocket, especially in Manhattan and some of the surrounding boroughs. And that's clearly, as you were saying, a real indication of where inflation is going and that it's not really slowing down. So given what we know, you already mentioned this briefly at the beginning of our chat about recession. Our chief investment office here does think that there's a 40% chance that we could see a recession in the next 12 months here in the U.S. And it sounds like you're seeing that as well. How do you think that then might compare to the recession that we saw in 2008 and 2009, but that the thought of that can certainly put fear into investors for sure. That was a really tough time for the economy, the markets in general.
Without question. And we don't see an 08, 09 scenario, mainly because of housing. When you look back at 08, 09, the debt behind housing was not very good paper, right? People were buying houses with no money down, no skin in the game. So they just walked out of their house, and we saw foreclosures go through the roof. This time around, this cycle reminds me more of the tech bubble burst, where these asset prices that inflated with these companies that have very weak balance sheets are imploding, and it's going to continue to implode in our opinion. So we think we'll have a recession without question. It just won't be as deep as 08, 09, mainly because we think the paper on housing is much stronger and better paper than what we had during that great recession of 08, 09. So that is some silver lining. That doesn't mean the market won't go down by 35 to 40% from peak to trough, because the market is not the economy.
Exactly. I'm glad you said that, because sometimes those things go hand in hand when people discuss the markets and investing. So clearly that is something that I'm glad you mentioned. And even when you look at things like the economy, when it comes to jobs are still growing. We just had the JOLTS job opening coming in higher than expectations just a couple of days ago. So there's still this health in the economy where you see in the jobs market, et cetera. So, obviously the next couple of months are going to be crucial to get a real reading of the economy. So given all this, Eddie, I always like to ask you before you leave us where you see opportunities for investors. I know you're talking to your own investors and clients on a regular basis. Where's the opportunity right now in this very volatile environment?
So look, I'm not going to sugarcoat this thing. There's very few places to hide right now. We do think we'll have some opportunities in the fourth quarter as we see volatility increase in September and October. I would tell investors right now, based on what we've done for clients, is make sure you have a healthy cash position. I think that's critical in a time period like this. And if you're going to be buying equities right now, I would stay in the utilities and healthcare and consumer staples space, because those are much more defensive. I don't think right now is the best opportunity to be buying growth stocks, because we think growth is going to continue to decelerate, and you will have a better opportunity, in our opinion, to be buying growth and small caps towards the end of this year or the first half of next year. So we're continuing to play defense, because we think patience ultimately is going to be the winning equation for our clients.
Terrific. Eddie, thank you very much. Appreciate that. And I always love your insights, and I know our viewers do as well. Thanks for joining us, Eddie. We'll speak to you soon.
Thank you. Have a good day.
You too. And for more information on anything coming out of UBS and our great partners, you can visit our website at ubs.com/views and follow us on social media. A lot of content there as well. LinkedIn, Facebook, Instagram, Twitter, plus all of our past UBS Trending episodes, just like this one, are available to watch on demand. And if you have any questions about your own portfolio, make sure to speak with a financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great day, everyone. And remember to keep your eyes on what's trending. We will see you soon.